Larry Kotlikoff debunks the bucket strategy, huh? Interesting, because you know me, I love the bucket strategy. Let's take a gander at this, because I chuckle, because basically this article has two parts, and it's interesting. My man Bob, I think, sent this to me. It's a good article for the first half. It's poor on the latter part just because it's too damn complex. And his strategy, which I enjoy thinking of, no one's going to do this. Look, I've done dozens upon dozens upon dozens of seminars with very smart people. You know what I'm saying? We're admirals, flag officers, physicists, the whole thing. And you start getting into the three bucket strategy, and people's eyes just glaze over because there's too many moving parts, man. It's too hard to follow, and so that's why I just came up with the barbell two bucket strategy. But I'm gonna quickly disabuse Larry of why the two bucket strategy works against what he says in this. Anyway, it's a good article. Upside, I guess the strategy that Larry does, I can't follow it. It makes my head spin. Maybe it's because I'm just a caveman. I don't understand your modern ways of buckets. But anyway, so upside investment is simple. It's a joint investment spending strategy. You invest in a stock or a combo risk of risky assets and tips. You build your base standard of living. Okay, that's fine. He basically is kind of a sales pitch for his Max 5 planner. And I don't use it, but I'm glad it's out there. I think it's a good tool for sure. All right, so the stock market is a casino with great odds. Its real average returns are 9.5%. But there's a 20% standard deviation around that average. In mathematical terms, the stock market is a random walk with a drift. The higher the drift, the higher the average return, the higher the chances of your initial bucket of stocks will reach a big value after 20 years. Yeah, 100%. However, if you withdraw, say, 4% per year, you lower the drift from 9.5 to 5.5. That means less upside and more downside. So, I mean, anyone disagrees with that? No, of course. The more money you're pulling from your portfolio, the less money is in there to capture the upside drift. All right, I completely agree. Still, I'll take 5.5%, but I don't use that. I don't use 9.5 in my financial planning. I use probably between basically 4.5 to 5.5, frankly. All right, withdrawing is said to generate a sequence of return risk. Okay, yeah, 100%. Regardless of the drift, with a random walk, there's no telling how much a bucket of stocks will be worth at a certain period of time when you need to cash out. And here's where I like this. If the U.S. market were, in real terms, to fall by half over the next 30 years, as the Japanese market did, a $100,000 investment today with no withdrawals would be worth just $51,000 in 30 years, in 2052. All right, did you hear that? If U.S. were to fall by half, like what happened to the Japanese market, $100,000 with no withdrawals, and this isn't adjusted for inflation either. If you adjust it for inflation, the real purchasing power would be a whole lot worse. Now, Japanese inflation wasn't very much, but it's still something. All right, but you're saying the U.S. stock market could have a negative return over 30 years? Are you nuts? The U.S. has never had a 30-year period with a negative return. And this is where Larry, is he now on what we've been saying with Michael Edison and others, with me, about the stock market? We don't have enough sample size. And the answer is, yes. My answer, the 63 observations of the 30-year cumulative U.S. returns use overlapping data. Consequently, they don't constitute independent observations. As I've said 1,000 times, if you take 1926 to 55, that's 30 years. I think that's 30 years. Yeah, there you go. 30. All right, the next 30 years, what people do 1927 to 1956. Well, that's 30 years as well. But 29 of those years overlap. So you literally have 97% similarities of these two 30 years periods of time. 97%. That is not statistically relevant. It's just not. And that's the whole thing. The stocks are less risky for the long term. They're just not, man. I mean, there's no evidence. It's just you don't have enough sample size. I like Larry's analogy here. Consider choosing an orange at Joe's grocery store and putting it into a bag together with another perfectly chosen orange. That's orange bag one. Then you hold on to the perfect orange and return. So you take the bag, all right, you go into the bag, you grab one of the oranges, you put that over it, you still have orange one in the bag, all right? So you have one orange in the bag and one orange you put back, all right? And then you hold on then you return the orange to the bin, mix all up the other oranges and grab another oranges at random from the bin and put in the bag. Now you put the newly chosen orange in the bag with the same perfect orange. You repeat this, say, 63 times, and then proclaim, every bag of 2 oranges I filled at Joe's had at least one perfect orange. That's 100%. Because you're overlapping data. The 98 years of U.S. annual stock return provide just 3 independent estimates of 30-year return on the market. I've said that 1,000 times, man. Just 3 bags of oranges, where both oranges have been drawn randomly from the bin. All right, and by the way, the 30-year average annualized real return between 1928 and 58 was just 0.5%. That's real net of inflation. Unfortunately, when it comes to stock data, the 3 data points are meaningless, 100%. But we do know something, indeed, a lot about stock returns simply based on the underlying random walk process. And particularly know the probability that a random walk with a log normal distribution, which is a standard assumption for stock returns, falls below a given low level is more likely the more time you give it process. Yep. And once your bucket has lost value, it's gone for good. So basically, the more, when you lose money, it matters not what the stock market does. That's all there's to it. When your money is out, it matters not what the average rates of return on the stock market is. That's kind of going back to the sequence of return thing. All right. Wall Street talks about stocks as if they're safe for the long term, but this helps sell product. But ask Wall Street to provide you insurance against a market decline. And as Boston Finance University guy Ziv Bodie at Boston University, he's a finance professor. Larry's an economics professor at BU. Who's the most prominent graduate in economics from BU? AOC. Just leave that. So that guy he had written an article in the part of 2009 where he's really inspired by Obama. I said, oh, God, dude, can anyone just think for themselves? I get it. These wealthy guys and academic elite, media, they love to show how supportive of Obama was. I get it, I get it. But just, to use that as kind of like, look, I imagine these guys are all pro-vax, the whole thing. It's nuts. Like, how dare you not take the jab? And I'll never forget that he wrote out, they said like 3 people that inspire you, like Gandhi, Obama, and friggin' Eleanor Roosevelt. I said, something like that. I remember it's Obama. So just because he gave a speech, the whole thing was it's just embarrassingly the white knight crap, and I hate that crap. Anyway, consider these statements I collected in 20 seconds by Googling bucket strategy. Morningstar. The stock markets can be risky in the short run. Time has a moderating effect on market risk. Oh, going back to evolution. Time creates order out of chaos. Time is this magic thing that can solve all problems. Time is essentially God. We're going to replace God with time. Funny. Smart asset. The long-term bucket grows your nest egg faster than inflation. Okay. Fidelity. If you separate out cash mentally and you know it can last long enough for the ride to turn, you feel better than you can ride it out. And here's where he gets into his anti-bucket strategy. The common patently false message is that stocks are safe for the long term. Let's see, hold on a second. As risk-averse humans, we care about specific outcomes, precisely what happens to us, and we worry far more about downside than the upside. The fact that the downside is so much worse than the upside is why a bucket strategy of stocks gets riskier, not safer over time. I don't think anyone would ever deny that, actually, frankly. I don't think anyone would. But if the alternative to that is to minimize the risk and a SPIA, single premium income annuity, is the only way to do that. But he didn't talk about it. In sum, Wall Street's bucketing strategy is a bad joke. Its focus on the market's high average cumulative return or the high chance of doing well on average is akin to basing your financial plan on dying precisely at your life expectancy, or the date which you will die on average. Worse, Wall Street takes you down another pretend for sure path. The pretense here is that bucketing is flooring your income and implication your living standard. All right, I don't understand it. So so basically he's bashing bucketing strategy by saying you're reducing your living standard because you're basically you don't have enough money in stocks, is what some of these guys say. And I'm putting words in Larry's mouth. You can read the article. I'm not going to read the whole damn thing for you. The reason you bucket is quite simple, actually. It's because you're hedging. Bucket is the ultimate what if I'm wrong strategy. What if I'm wrong? All right, so we have stocks. We'll draw this out if I can find my. Here we go. Look at that. And we have cash. And you can however you want to do it. You know, so if I, for instance, cash, and we're going to use Wellington, which is 65.35. All right. So here, the ultimate 3-bucket strategy is cash and Wellington. All right, because you got Wellington is about 35% bonds, 65% stocks. All right. The point being is, if the markets go down, you don't have to take out from this portfolio. You can take out from this instead. All right. That way you're not selling when it's down. If the markets go up, you can take out from this portfolio and not this portfolio. It's just that simple. I mean, it's just the ultimate hedge. We have no clue what the markets are going to do. We're not basing it on a 9.5% average rate of return. That'd be stupid. We're not even basing it on what your life expectancy is. I mean, some way you got to predict the day you die. But I mean, this is what the bucket does. It's easy to manage. You're not limiting your you're not limiting your consumption like Larry says here. The pretense here is that the bucketing is flooring your income by implication your living standard. No, it's not. I mean, it's silly to say that. You're just saying basically I got 3, 4, 5 years of cash or short-term bonds. I like Ginnie Mae. I got the rest on something else. I mean, it's just that simple. And why I like Wellington is because of the Japan scenario. Bonds did fine in Japan. I mean, you ran out of money, but there's no way to not run out of money unless you put everything into a SPIA from the get-go. Now, Larry might say, well, if you do this strategy, we're converting a certain amount to look, all that stuff is freaking boring. And Zviv Bodhi talked about that 15 years ago about just buying a bunch of tips. And I got no qualm with that, man. But if you just might as well buy half tips, half SPIAs. I got no qualm with that at all. None whatsoever. Where I'm saying, though, is the bucketing strategy isn't to give you and this is what that guy, Rob Berger, you're leaving money on the table. It's like, no, the bucket, we're done with all that. Once you retire, we're done with freaking trying to maximize performance. At this stage, what we're trying to do is minimize downside risk. But we still have to have some equities in there in case the market continues to grow at the rate of inflation or better, because we don't know. That's what the bucket does. And it says that worst case scenario, I got 3 to 4 years cash. All right, I take off that. Who knows if the market's going to come back? I don't know. It could go the way of Japan. If it went the way of Japan, you're like, wow, I got all this cash. You're still running out of money, man. You're still running out of money. The only way to guarantee you from not running out of money is to do a SPIA. Even if you did tips, if you're taking 4 or 5% of your portfolio here, you're going to run out of money too, because tips aren't going to keep up with that. Anyway, it's frustrating to me. I don't know why people got to make... I don't know why people got to make an issue of the bucket strategy as in terms of the day-to-day of financial planning. It's like the bucket strategy has nothing to do with maximizing upside, nothing to do with increasing your standard of living. We're trying to maintain a certain standard of living. That's what we're trying to do. If you want to increase your standard of living, you might, I mean, look, I don't think very many people go into retirement and say, I want to increase my standard of living. I was spending $100,000 a year. Now I want to spend $150,000. I mean, some do, I grant you. And those people are going to have to choose whether or not they want to take that risk if the markets go kaput. But the idea is the vast majority will say, yeah, I'm pretty content, man. I just want to make sure I don't run out of money. And the bucket strategy is great for that. Will it guarantee you a success? No. Will tips guarantee you success? No. Hell no. The only way that guarantees you success is a SPIA, is an income annuity. That's it. But even that, incomes and annuities aren't adjusted for inflation, so it stays flat. In my research, I'm not even concerned that's that big of a deal. Actually, my forthcoming book, fifth or sixth book, an inflation myth in your retirement plan. So stay tuned. Love to hear your thoughts. We'll see you.